Hello and welcome to this particular session. And in today's video, I'm basically going to talk about how to combine liquidity together with the Fibonacci tool so as to get a high probability setup, right? So I came to realize that most traders are using Fibonacci tool blindly. That is pulling it from swing low to swing high and entering trades at maybe probably 61.8 or maybe 50% retracements. But if you look at what the smart money concept or the CMC, what CMC teaches basically is that price does not reverse at fib levels because of the level in quotes, but it reverses because there is liquidity near those levels, right? So that is what you need to understand. So it's not just about price reversing to 61.8 to 50% levels, but it reverses in those levels, especially when liquidity is near those particular levels. All right. So what you need to understand is that your fib becomes one of the most powerful tool that you can use only when it aligns with a liquidity pool or maybe probably a liquidity sweep. Okay, so the core idea in this particular video, what I'm going to share here is use how to use fib to measure the premium and discount. Also, we are going to use liquidity to confirm where smart money will likely take prices before reversing. All right. So, and we are going to do it step by step. And step one, it's identifying the swing leg. All right. Step one is identifying the swing leg. Okay. So, and this should be basically using the structure, the kind of structure that we have. All right. So I'm going to give you this example here. All right. We have an example, maybe probably different examples here. Okay. So, and this liquidity, they can be maybe probably equal lows. All right. So we are going to talk about that in the next step, number 2. So choose, so the first step is to identify the swing leg. So you need to choose the leg that broke a BOS, right? The leg that broke a BOS, all right? So let's look at this. Of course, we are guided by the structure. This has been a downtrend, all right? So this has been a downtrend. So we see the first leg here, all right? This one that broke the BOS. We have a BOS at that particular point. And we also have a BOS at this particular level here. Okay, we also have a BOS at this particular point, right? So if you look at this particular scenario here, these are lows. When the price is creating the BOS, these are lows that are being taken out. Okay, these are lows that are being taken out. Okay, so so when we are looking at maybe probably a bullish trend, therefore we want to look at the swing low to swing high. If you are looking at a bearish trend like this one, we want to look at swing from swing highs to swing lows, right? So from swing highs, okay, from swing highs to swing lows, right? From swing highs to swing lows. You can see that. Okay, that is very eminent. All right. So then this leg basically represents the order flow of smart money. Okay, so let's look at a bullish scenario. So if you look at a bullish scenario, when the market is in an uptrend, we see this kind of scenario here. The market creates a BOS, all right? The market creates a BOS, okay? So here the market creates a BOS. So you want to identify the swing low, all right? The swing low all the way to the swing high, okay? The swing low all the way to the swing, all the way to the swing high, because this is what the BOS is. So this is definitely the swing high, right? The swing low, and this is the swing high, right? So that is very, very significant. Okay. So once you have done that, then like I said, this leg, or what you are seeing here, this leg you are seeing here, it's basically representing the order flow of smart money, right? It's representing the order flow of smart money. Okay, so step number 2, mark liquidity above and below the extreme. So we want to mark liquidity above, right? Liquidity above. So when you're talking about this particular point now, because you have already seen that, so where is the liquidity in this level? Right, so we have this liquidity here. All right, we have these liquidity levels here at this particular point. Okay, so we have that. Also, we can say this is a liquidity level as well. All right, that is a liquidity level as well in the bigger picture. All right, and below where we have liquidity is at this particular point. That's where we have liquidity here. All right, that's where we have liquidity. Okay, so when you are marking this liquidity either above or extreme, so basically is let's take an instance of maybe probably this bullish trend. So where liquidity is resting, so liquidities are resting here. First of all, we have seen this liquidity being taken out, right? But we have a BOS at this particular point. Okay, so where the liquidity is resting above this, because now this shows the smart money direction or order flow. So we have the first liquidity here, we have the second liquidity at this particular point. This liquidity you're marking, they can be equal lows, equal highs, previous highs, previous lows, trend line liquidity, right? Buy side or sell side liquidity pools, and even fair value gaps and imbalances. These are all liquidities, right? So on this other one, we said this is the leg here. So where are we identifying our liquidity? We want to identify our liquidity below, right? So the first liquidity zone we have is there, right, where we at that particular point where we had the BOS. Okay, the next liquidity we have it's this one here, right? That is the next liquidity we have here. So looking at that, I'm going to explain, and then we have the other liquidity at that particular point, right? So that's how you identify liquidity, and this is actually a very powerful one because it's a New York law, right? So then step number 3, use the Fibonacci to determine the premium and discount zones, right? So in an uptrend, basically 0 to 50, all right, 0 to 50 is the, I mean, let me show you. Instead of using the Fibonacci, you can just use this tool here. So how to get that tool? You come here and you'll see this data range and price. All right, so this is the bullish scenario. We have identified our range, right, from this low to this high, right, from that low to this high. You see the high here, right? So the low to the high, right? So above this is a premium. Okay, so above this is from above this line, this zone here, the entire of this zone. Let me show you the entire of this zone. That is premium. Okay, and premium basically, smart money, they look at selling in premium. Okay, in discount, the from that point to this level, that's the discount. Premium, smart money um, looks to buying a discount, especially in an uptrend. Okay, so now once you do that, the next thing you want to do is pull out your fib. For me, I use the ICT Fibonacci retracement and extension. To basically know how to set that, you can check the video I did about ICT Classic Fibonacci. Okay, so what I'll do, I will pull from the low to the highest point. All right, I'll pull from the low to the highest point. Okay, so this is the leg that we identified here. This is the low point, this is the highest point. So I want to look at entries. Now I can delete these entries because you have said this is the premium, this is the discount, right? All this is discount, so that's where we want to look at our entries. Now let's delete this tool that was showing us the discount and premium. So I want to look at my entries around this particular level. Okay, and as you can see, right, as you can see here clearly, the price, right, the price came all the way to the Fibonacci level. Okay, the price came all the way to the Fibonacci level, which is in discount, and in discount the smart money looks for buying opportunities. Okay, so I can now delete that, right? So we see the price coming to these particular points. So we have marked our Fibonacci, right? We have marked our Fibonacci. So what next, right? What next? So even on this other side, right, on this other side, you'll just do the same. Okay, so you mark from the swing high to the swing low, right? You mark from the swing high to the swing low, right? And because this is a bearish trajectory, just a minute, because this is a bearish trend, all right, this is a bearish trend, so you mark from the high to the low. And because this is a bearish trajectory, of course, you're marking from the swing high to the swing low. For a bullish trend, we are marking from swing low to the swing high, because this is the leg that we identified here, right? Believe you're all together up to that point. So what is next now that we need to do? The other thing that we need to do here is now find the liquidity sweep before the retracement. That is very important. Okay, so if you look at this particular point, all these were the liquidity sweeps, right, before the retracement. As the price pushed up here, right, as the price pushed up here, it has swept all these liquidities, right? It has swept all these liquidities, including these liquidities, right? And then what it did after sweeping the liquidities, it retraced to the Fibonacci OTE level, optimal trade level, right? In a bearish scenario, what we can see here, the price pushed all the way down, all right? It pushed all the way down, okay, and swept out these liquidities here before now retracement, right? Before retracement. So that is very important for you to understand. Maybe I can pull it like this, all right? So it pulled all the way down to this level. The price pushed from this point all the way to this point, and as it went down, it created a BOS, so it took out these intermediate liquidities before retracing to the Fibonacci OTE level, right? So then that is not just that does not mean that you take the setup. Okay, of course you want some confluences, and confluences are the ones that basically makes a trade more high probability, right? So for me, what I'll do before I take the trade, I will look at the confluence zones, right, which will give me now high probability trades. And when now you're using this Fibonacci, it becomes high probability only if you align maybe probably with an order block, you align maybe probably with a fair value gap, you align maybe probably with a liquidity pool, or maybe probably a displaced candle or market structure shift, right? So for me, I'm going to show it basically using the order blocks, because that's what I trade most of the time, all right? That's my strategy. So when I look at this particular case here, I first of all want to understand if this is a high probability order block, all right? And I've also done a video about identifying high probability order block, all right? So first, we want to see the BOS, which happened here. You can see the bodies of the candlestick closed above. So let me delete that. So here we have a BOS. So the moment we have a BOS, then I want to come back and mark my order block, all right? And where is my order block? This last, in a bullish trend, the last sell candle before the price pushing up, that's what gives us an order block. And this is the level of the order block, the entire of that. That's how we mark. Okay, I know it's this sell candle, but we factor the wicks here, right? So this is the entire of the order block, all right? So but now you can see the price came in and digged deeper, almost the mean threshold of that particular OB, right? So we have the fibs, and the price is within an order block, and therefore this is how my entry should look like, all right? That's how my entry should look like. I don't take the trade here because this order block is quite big, so I want a confluence when the price has come to the optimal trade entry. Okay, optimal trade entry. So you need to have your stop loss slightly below that, and maybe probably now we target maybe something like that. I'm going to explain that. Right now I'm just showing you the entry. So also here the same concept, right? So I want to look at confluence, especially the order blocks, and at this particular point, that's where we have the order block. Once we see this BOS, we mark the last bullish candle before the displacement on the downside, and this is our order block. Right, this is our order block. That is our order block. Okay, that is our order block. Perfect. Okay, so then now once we have that, then I can have a short entry at this particular point. Okay, I can have a short entry at that particular level, have my stop loss slightly above that OB, right? And then maybe probably target the price to come all the way to this level or even this level, right? Let's even say this level. Right, let's even talk about that level. Right, so that's a sell entry. Okay, I believe we are all together. So when maybe probably in a bullish scenario now, remember we have first of all we have seen the price making higher highs. All right, we have seen the price making higher highs and higher lows. So we mark the swing leg that broke the structure, all right, or that created a break of structure. So we did mark that. So that was this one, right? This leg here. Okay, this leg here, this is what broke the structure here. Okay, so then we pull the fib from the low point to the highest point. Then we look for a point of confluence, right, which is an order block. This is an order block, but then I want the price to tap the OTE level, or the fib retracement level. That is the OTE, because I use the ICT Fibonacci, and from that now I can take my trade. So when I take my trade, what am I basically doing? Right, so what I'll do is that now I will target the liquidities, right? So when I take the trade here, my first target actually should be, right, should be these liquidity levels here where the price reached before retracing. That should be my first target. Then my second target, I can use these liquidity levels here, right? I can use those liquidity levels there, or maybe probably I can use an opposing order block, right? Maybe probably a bearish order block as my target, or maybe probably the liquidity zones here, the buy side liquidities at this particular point. And as you can see, the price went all the way up. It even went all the way up to this particular level. Now in this case scenario, that's where now you use maybe probably an opposing order block, because here we have an opposing bearish order block. Remember, we entered in this bullish order block, so you can as well be able to target that. So when you have these kind of extreme targets, what is advised is first of all, you can take maybe probably partials. Once using these liquidity levels, you can take partials. Okay, alternatively, if you don't want to maybe probably to eyeball all that, maybe probably you can use up to the maximum of the Fibonacci, right? So because the Fibonacci has all these levels here, so you can use maybe probably at that particular point, and you can see it's giving quite some good risk to reward ratio. If you target the liquidities there, we are talking about 1:4. If you target these levels, you're talking about 1:7. Okay, 1:7 risk to reward ratio. So the same case for a sell. So I identify the price making lower lows and lower highs, right? So then I mark the leg. This is the leg that we marked from this point all the way to this level. So then I identify, once I see the break of structure here, I look at a retracement. I look at an order block. Here it is. Then I mark my Fibonacci, and I wait for the price to come into this confluence zone. That's where we have the order block. That's where we have the Fibonacci. Okay, so and then now you can check that particular sell. So here you can use the first point of interest, of course, are these lows here. All right, these lows here. Maybe probably then thereafter we can target these liquidities. All right, you see these liquidities at this particular point, you can target that, and you can see the price came all the way to that particular point, right? So that's how you use the concept of liquidity plus the Fibonacci for you to be able to get high probability entries. Okay, so I am going to delete this and show you another example because it's slightly near to this, right? So here too, as you can see, the price pushes on the downside, creates another liquidity there. All right, it takes out these liquidities, pushes on the downside. Okay, so then once we see that, of course, we want to mark our leg. So our leg is from this point to this point, the low to the high to the low point. Okay, so what we want to do then is now use the Fibonacci from the high point to the lowest point. Okay, from the highest point to the lowest point, and then now we want the price to pull back to the OTE levels, which is also aligning itself with the OB. All right, you can see how it came and touched this particular order block, right? And then we see the price push on the downside. Of course, our target, if you take this sell, this is how your setup will be, like that. Stop loss slightly above that, and then we target these liquidity zones, and you can see the price push all the way down, retraced again, came to the same level, and now we saw the price push on the downside to give us the entries that we are anticipating or that we are looking at. Okay, so that is really very, very important. All right, so that's how we use the Fibonacci plus the liquidity zones, basically to be able to get high probability setup. Right, so so for ICT traders, basically, how do we enter these setups? Of course, at the Fibonacci OTE level, and this is whereby we want to wait for the liquidity sweep, market structure shift or break of structure. The price taps into a discount zone for buys, or the price taps into a premium zone for sales, right? And then now you redefine your entry, maybe probably using a confluence of an OB, a fair value gap, etc. Right? So why this concept is very important is because you need to understand that liquidity tells you why price should reverse, right? Fibonacci tells you where it will likely reverse, and price action tells you when to enter. So when you combine those three aspects, all right, liquidity tells you why the price should reverse. Fibonacci tells you where it is likely to reverse, and the price action now tells you when to enter. Okay, so from this, it's quite informative. It's quite really informative, and it's quite a very powerful strategy. So what I'll challenge you to do is now you go backtest that particular concept. You do a lot of backtest until you become confident with the strategy, and then now maybe probably you can test it slightly in your demonstration account, and then now you can transition to the live account, right? So I believe you found these insights you find these insightful, and even as we are in the holiday seasons, all I can say is wishing you a Merry Christmas and a Happy New Year. But again, I'm here basically to keep you busy through education, making sure that even in your holidays, you become in tandem with the market, all right? You become in sync with the market, okay? So that come January 2026, at least you are able to have a very promising and fruitful year ahead. All right. So thank you guys, and see you in the next one.